Good evening, everyone. What a pleasure it is to be here with you all. I would especially like to welcome Chester's Board of Directors and Company Executives Courtney Brennan, Kai Hin Shung, Jessie Fazakerali, Bopang Hu, and Priya Reshi. In addition, it's wonderful to see Chester's shareholders well represented with us here tonight. My name is Emilie Jones and I'm the Communications and Ethics Specialist of Wheel Consultants, and joining me tonight is Finance Director Mr Ryan Enan, Director of Operations and Marketing Mr Bradley McAuliffe, and our Management Accountant and Analyst Mrs Alison Fergerson. Wheel Consultants were engaged by Chester's Board of Directors at the end of 2027 to provide review and analysis of the company's performance over the past 8 years. In assisting to inform Chester's strategic planning and in aiming to validate shareholder confidence, Wheel Consultants have reviewed, analysed and will report to you on the following. Chester's existing strategy and ethical positioning, noted areas of company oversight, the impacts observed following the change to executive management in 2023, and finally, we will provide you with an overview of the competitor landscape in which Chester operates. So let's begin the formalities of tonight's presentation with Mr. Ryan Enan.
Thank you, Emily. Hi, my name is Ryan and I'm the Finance Director of Wheel Consultants. I'm here to talk about Chester and their overall strategy. Chester was first established on the 31st of December 2019 with an overall focus on the diverse needs of all their stakeholders. Chester is doing this by providing various niche products at reasonable prices. Chester has 6 overall products that covers all aspects of the market segment. The goal of Chester is providing niche products to their stakeholders by providing the most cost-effective product in their traditional and low-end segment, and the focus on high contribution margin efficiency in their high-end segment. Since 2019, Chester has used a niche cost leader strategy to target their low and traditional segments, offering consumers products that match their ideal criteria regarding age, positioning, and reliability. The high-end segment has been met with a niche differentiator strategy that has aimed to keep pace with the technology-motivated consumers who demand products of improved size and performance. Chester's strategy for research and development has been to add new and exciting products whenever possible and maintain a presence in every segment. They are offering products to consumers that match their ideal criteria for positioning, age, and reliability. Chester's marketing strategy over the past 8 years has been to keep pace with the awareness and accessibility of their competitors' products. Chester commenced operations in 2019 with an early cost leadership model and responded with changes to sales and promo budgets depending on the market and their competitive behavior within each relevant year. Noted is Chester's lower than average prices across low traditional segments when compared to competitor pricing over 8 years. Of interest is aggressive promotion and sales investment noted in the niche differentiator segment aimed at improving the reputation of their superior products with high accessibility and premium pricing. Chester made sure that they invested in automation early on in their low end and their traditional segments to decrease further costs even more. For their niche differentiator, they decided to grow capacity and meet generated demands for products by moderately investing in automation, but not to the point where the expense would prevent them from repositioning their product in the high-end segment. In terms of finance, Chester financed their cost-effective, competitive, and high-quality products predominantly through long-term bonds. However, when required, Chester also issued stock offerings to increase their cash position, for an additional investment was required. Chester repaid their loyal shareholders with a generous dividend policy when they maintained a high-level positive cash flow position. It was also important to notice that Chester, although financed through long-term bonds, managed to keep their leverage between 1.8 to 2.5 throughout its operations. In terms of mistakes Chester made throughout its operations, in 2020, Chester did not produce enough products to meet overall demand, therefore missing out on a large number of sales and profits. In 2021, Chester incurred an emergency loan of $11,878,785, which in turn caused their share price to drop considerably by $10.64. This was because the company spent $10,000 for plant improvement, paid $1,000 for dividend, and retired stock even more of $2,600 when they already had low profits and a high expenditure. In 2023, Chester had incurred another emergency loan of $20 million. Contribution margin was reduced to 24.9% and their share price dropped to $38.25. This was because the products from all segments were overproduced as shown below. In 2024, Chester had an emergency loan of $28 million, as the company offered the employees a very high rate which brought down the contribution margin to 26.9%. Even though the company's market share was the second highest at the time right after Digby, because of the low contribution margin, the company was very less profitable, which in turn caused the share price to drop by $22.03. Finally, I'd like to end with the ethical considerations of Chester. In terms of labor negotiations, Chester has been a very fair company by offering its employees a very fair rate of $28, being the second highest at the time after Erie. This shows Chester's contribution to its employees, that it's not all about profit and they want to keep their employees happy. It is very important to note, however, in 2023, the employee turnover rate for Chester was very high at 10.6%. This was because there was a lack of training of employees. Thank you for listening to me. I would now like to hand over to our Operations and Marketing Director, Brad, who will now review the impacts of the executive management change.
Thank you, Ryan. In this analysis of Chester's performance, I'll be covering the results stemming from the executive shake-up in 2023, discussing strategy and decisions made by the company and how they were implemented around the shake-up. The two charts you're seeing show Chester's cumulative profit at the end of each year plotted against the industry average, and the return on sales percentage also plotted against the industry average. After a slow start, Chester rebounded in 2022, leaping above the industry average for both cumulative profit and ROS. Profit stagnated in 2023, with ROS suffering a steep decline, giving Chester a shaky position for the executive shake-up. The new executive would be coming into the company at a moment where they needed to return to increasing profit and have positive ROS in order to compete against the other companies. The charts here show this wasn't the case, and Chester continued to suffer after the shake-up, seeing negative profits through the following 3 years and an ROS that plummeted below zero. So why did this occur? What decisions led to this downturn in performance, and why didn't it improve with the introduction of the new executive? The first issue with Chester was their emergency loans. While unfortunate and unexpected, emergency loans are a massive detractor for a company, especially when they're not paid off immediately or they happen over multiple years. Chester's emergency loans in 2021 and 2023 show the company didn't effectively finance their investments before the shake-up. In 2024, Chester's emergency loan actually increased, showing that after the shake-up, financing didn't improve as the company slowly added long-term debt without considering issuing stock or attempting to build on retained profit. The company closed in 2027 with just over 2 million shares, the lowest of all companies having actually retired shares in the final year. This lack of effective financing could have been a massive improvement for Chester that may have led to more success post-shake-up. Secondly, poor inventory management constrained Chester's profits throughout the 9-year period. Leftover inventory is inefficient and leaves the company overspending on production, potentially being a source for the emergency loans just discussed. In 2023, Chester had 26% stock left over, and in 2024, after the new executive arrived, they had 24.5%. This was a huge problem missed by original executives and also their new executive post-shake-up. In 2021, Chester introduced their new product, Code, into the high-end segment. Leading into the shake-up, this product could have been set up to succeed with the company's rise in profits. However, the product wasn't given enough attention, leading to it stagnating along with the company as a whole through the shake-up. After the shake-up, the new executive didn't introduce a clear plan for the product, with Code staying at around 450 sales each year due to it being too far behind its competitors to catch up and gain market share. This ties into a lack of effective financing, as Chester could have developed this product quicker through the effective use of stock issuing and long-term debt in order to have it succeed sooner. This product was let slip in order to move it into the traditional segment, an effective move as seen by results in 2027. However, this was much too late and should have been done immediately after the shake-up. I will now pass you on to our management accountant, Ali Fergerson.
Thank you, Brad. Now we will look how Chester shapes up compared to their competitors in the industry over the last 8 years. We analysed the following statistics: return on sales, asset turnover, return on assets, return on equity, sales, profits, contribution margin, market share and stock price. In assessing where Chester sits in the industry, we can identify the competitive threats to the company and explore the possible strengths to exploit and the weaknesses to strengthen. Displaying the best performing company in red and the worst in yellow, we can see where Chester, the blue line, sits by comparison. Chester's performance may have fluctuated a lot over the last 8 years, but generally still remained one of the middle performing companies in the industry. Using these same statistics, we identified Digby Limited as the highest performing company. Digby Limited has a strong presence in the industry within each market segment, consistently holding the highest market share and the highest total sales. Digby has maintained their leadership. Digby has shown strong investments in expanding their capacity, introducing new products into the industry, and continuing to operate above capacity with over 100% plant utilisation each year. On the other side of the scale, Baldwin Limited struggled to maintain their presence in the industry. The company found it difficult to keep a presence in every market segment and no longer servicing the performance segment in 2025. With low investment spending, poor decisions with cash flows, and a high inventory carry cost, Baldwin's shareholders were slow to be impressed. At the close of 2027, Baldwin management are turning the company around, showing better performance. However, the company has lost its market share considerably. Now we can look at Chester's strengths and weaknesses and how they can be addressed as opportunities and threats to mitigate to achieve an overall increase in competitive advantage. Chester has shown strength maintaining a presence in every market segment, and management have made sound decisions to date. However, weaknesses are showing in the high performance and size markets where products are not fully meeting customer expectations. There is an opportunity for Chester to expand their capacity to meet customer demand in most segments, combined with increasing automation to keep labour costs low. However, Chester need to keep a close eye on competitors' research and development into new innovations that could outsell Chester's products. Taking all these aspects into consideration, Chester can improve their competitive advantage by increasing sound investments into capacity and automation in all market segments. They need to continue to improve their current products with new innovations, while still keeping a very close eye on customer expectations and competitors' presence in all these market segments. Now I hand you back to Emilie to conclude this presentation.
In summary, and in looking forward, Wheel Consultants observes great potential for Chester's growth, with the review process uncovering straightforward implementation opportunities to aid the company in the pursuit of excellence and in disturbing the industry landscape amongst leading competitors. Wheel Consultants acknowledges Chester's strong focus on employee value, where pay negotiations of 2022 and 2024 led to employees being positively remunerated. With reference to John Rutledge's claim that ethical negotiations are not only morally right but also bolster profitability, Chester should draw confidence from their priority for employee satisfaction and continue to drive this focus. In addressing the company's fluctuating performance over the past 8 years, which can be largely attributed to the inefficiencies in production forecasting and financing decisions, Wheel Consultants have noted that Chester should look to industry leader Digby. Digby's success in these areas proves that investment in capacity, investment in R&D, development of new product lines, increased automation and maximisation of plant utilisation should be considered by Chester for immediate consideration and implementation. The overall focus, therefore, is to lower costs whilst increasing profitability. The introduction of the new executive in 2023 caused great upheaval for Chester, and with the knowledge that new executives bring new and different management practices with them, what appears is that Chester's executives and employees have never quite transitioned in this space. Change is often slow. However, after 4 years, the dust should have settled by now. As such, Wheel Consultants believes that further shake-up may be necessary to address ongoing financing and forecasting indiscretions. So the plan for Chester is simple: clear leadership and direction, a focus on investment, effective financing and tight production schedules. And with this in place, we expect to see Chester move quickly into the higher echelons of the market. Wheel Consultants is privileged to provide this evening's presentation to Chester's Board of Directors and shareholders in attendance. We look forward to engaging the audience in robust discussions aimed at strengthening the industry position of Chester. Thank you.